Welcome to the free life insurance training video provided by lifeinsurancetrainers.com. We're going to talk about one of the most confusing things to new agents that when I'm training, and that's option A versus option B. Well, what exactly, and again, we've defined this in a previous video, but we're going to dive in a little more, is what is actually going on here. Well, as we've said before, option A is a level death benefit. Option B is an increasing death benefit. The emphasis on option A is you control the cost. If your $100,000 policy is remain level as your cash grows, you're not purchasing extra coverage. You're controlling the cost, which allows the investment to grow better than the death benefit. And conversely, as option B is elected for the opposite, to grow the coverage. And there's some extra cost in there for that, but we'll talk more about that. But that's the differences there. So the premium. Well, I normally would choose an option A if someone told me they were limited on the premium that they could put or wanted to put into this universal life plan. I'm more likely going to lean toward an option A if they have a set amount. Now, if their idea is to put maximum premium, is to maximize what this plan can do, then chances are B is a better option because it allows them to put a lot more money into the plan, the same size plan, because it's going to be growing each year. Now, let's look at this. Let's consider a male, $250,000 coverage, age 30, preferred rating, and these numbers, of course, are examples only, but I wanted to give you a visual as to option A. Option A is a level death benefit. So then you're going to be putting some premiums in there. And let's just say the minimum premium is $1,500 a month, and the maximum, let's say $1,500 a year because we're talking about a 35-year-old. So the minimum premium is $1,500 a year. The maximum premium is $3,000. And again, I'm just making some numbers up here to give you a visual. Now, you're going to have some cash value that's going to grow. And let's just push this out to age 65 when the cash value starts to grow more than, hopefully, more than the $250,000 that the death benefit is. If that's the case, option A will be forced to go up because what? You can have more cash in a policy than death benefit. You can't have $500,000 of cash into a $250,000 life policy. It's going to force that death benefit up a little bit above the cash growth inside of there. So, and now plans are being designed to age 121. So as the cash grows, and again, you could actually probably stop paying into that at some point, but they will go out for a long time. They're designed to go out to age 121 now. Now, let's look at option B. Same fella, same guy, $250,000 policy, option B, with the same premium, same plan, right? Now, because you've elected option B, which is a growing plan, you've opened up the ceiling to the client. You've opened up, and again, we're not limiting the cost of the plan. If we were limiting the cost, if the client said, Mark, I could only give you $3,000, I'm never going to put more than $3,000, you most certainly would want to go with an option A and levelize the plan. But if the client says, hey, I want the $250,000, but I could see myself, I want to start trying to max fund this thing, and that'll allow a lot more money because your death benefit is going to immediately start to go up as your cash value goes up. So let's use an example. You put $1,500 in the first year. Your cash value, let's say, minus fees and whatever, your cash value grows by $1,200. Well, if you were to die after the first year, your beneficiary would get $250,000 plus the $1,200. So the cash value, the death benefit grows accordingly to the cash value. Again, that last age 121.